Thanks, JC and the CFA Society for inviting me to moderate this session of an investor who I look up to a lot, one of the best investors I know, very dear friend, Kuntal Shah. He has more than 3 decades of experience in equity investing. He is also one of the key members on the board of Flame Institute, uh, and he also has a lot of enterprise seed investing, and also is co-founder of Needle.ai, which all of us are using a lot and has helped us a lot to make our task easier. Kuntal is interested in further enhancing skills and apply experience cultivated over multi-business cycle tracking and analyzing of select businesses and knowledge of what to focus on and what not to do. Apart from that, Kuntal also does a lot of talks with IIT, IIT Mumbai, IIM Ahmedabad, CA Institute, and Flame University. Also, what I've seen is he's one of the sharpest investors who catches trends quite well. I think everybody should read the recent note they have put out on solar, a huge, very, very detailed note. Everybody should read that. I think it is on Value Picker. This is the kind of work which Kuntal does and his team does. He is currently at Oaklane Capital, founding partner there, managing funds for family offices. So without much ado, I would like to invite Kuntal Shah for an excellent presentation, something which is close to my heart, which is the art of selling. I think it is not spoken about too much, but it will be very interesting, and I'm looking forward to it.
So, as with any last sessions, the star batsmen have come, they've batted. All-rounders have delivered knockout punch, and it's now left to the tail-enders like me to close the sessions. So, please bear in mind that this is a tail-end session and keep your expectation extremely low. When this presentation was getting made, markets were at all-time high, gold was at all-time high, real estates were all-time high, most of the asset classes were at all-time high. Some of the froth seems to be gradually unwinding, but coming to this presentation, there's a lot of literature and material on what to buy, when to buy, how to buy, so on and so forth. But investing is a very dark continent for the investors, the selling part at least. So this presentation talks about how do you see the selling decisions. You know, once you bought and hold the stock, what do you do when the time comes to sell the stock? So there's tons of advice floating on the buy side, and there are no takers for anything on the sell side. And it's very obvious because when you are talking about buying, it can appeal to a wide audience, but when you are talking about selling, it will only appeal to people who own the stocks or a particular stock or so on and so forth. So it's a very asymmetric discussion, buying versus selling. Also, many of us have heard the literature that Abhimanyu, who was the son of Arjun, learned about getting into the Abhimanyu Chakravyuh, as it called, very early, while actually he was a baby in the womb of the mother. But he never learned how to exit the Chakravyuh. And then what happened during the time of the battle was obviously fought valiantly. He really put on a brave show, but he couldn't come out of the Chakravyuh. So the question is, do you allow market to dictate your exit or you dictate your exit? That's a fundamental question which we are trying to address here. The journey of investing consists of predominantly these 5 decisions: what to buy, when to buy, how much to buy, sizing it up as the company delivers, a long holding period. So every investment which does well, every business which does well has a great initial window of purchase, a long holding period, as Rajiv said, and probably sometimes a narrow sell opportunity window. So the point of discussion of this summary is we are aware of the pitfalls which occur at the time of buying and holding. But what happens streaming? Suppose a stock becomes an exceptionally large portion of your portfolio, and the stock owns you rather than you owning the stock. What do you do then? Also, what do you do at the time of selling? And the selling decisions can be from multiple vantage point. Some of them could be, purely on the valuation. Some of it could be a better opportunity appearing on horizons. Sometimes it could be some management discretion which has happened in the process and so on and so forth. So we are going to talk about, how does one take a sell decisions. Also, please understand that this is a game where you can't borrow somebody else's playbook. So on the screen are many esteemed investors who have done very well, practicing their art in the domain which they were expert at. But they had the right ingredients, the right temperament, the right capital base, the right stability of the capital, etc., to execute their craft. Copying their playbook may not be viable for an average shareholder because the circumstances and the arsenal at their disposal are quite different. And so is the temperament and the ability to do the analysis and take the risk. These are different, these are not homogeneous, these are highly heterogeneous and highly people dependent. So you just can't blindly copy somebody's playbook. And let me illustrate further with the example of people we all talk about, Warren Buffett and Charlie Munger. Like we copy their, what they say verbatim without realizing the context. And I'm going to go show you some of them, the context, how they are different. So Berkshire Hathaway has, Warren Buffett has spoken about airlines, that airlines are bad business. But he has owned all the 4 airlines at some point of time, sometimes 2 or 3 times in his career. Number 2, he said diversification is hedge against ignorance, But if you see Berkshire portfolio, it's one of the most diversified conglomerate you can find in the investing world. Also, he's talked about technology, that change of technology underlying makes it very difficult for investor to make money in long run. But Apple has been one of the biggest performer in his portfolio. And also when you see, he's spoken about derivatives, that derivatives are weapons of mass destruction. But Berkshire is also one of the biggest underwriter of complex derivative and insurance products in the whole world. Basically, what I'm trying to tell you is what he practices is a craft which he is answerable to himself. But what he's teaching is to general masses, which applies to broad category of investor in general. You can't just verbatimly quote him out of the context and make it applicable to your own. Also, he said the famous quote, you should have a card with the 20 punching holes, and each time you make an investment, fill the hole. So that make less number of decisions, but well thought of decisions. But if you look at his own record, average holding period of 60% of the stock has been less than a year. So he's been actually actively churning his portfolio. This just to highlight that you can't blindly copy-paste somebody else's playbook and apply in your own game. There are many ways to skin the cat. There are many previous speakers who have spoken about this. So when you look at the buying and holding and the selling decisions, you got to be mindful of what kind of mandate you have, what kind of structure you have, what kind of investment philosophies you do, what is your style of investing, what is the duration of your investment horizon, what is the stability of the capital, is it long-term, is it short-term, and what is the stability of your own temperament, how skilled you are, what is your reaction to drawdowns, what is your reactions to adverse circumstances. All these factors are converging at the same point of time, and that's why this is a simple but not an easy exercise generally. I'll pause here on this slide. This is an important slide. Our behavior towards risk and reward changes with time. It evolves. It's not a static phenomena. There are times when you are very greedy. There are times when we are highly fearful of losing money. So we behave very differently in different risk-reward frameworks as they evolve. To just highlight, sometimes we behave like a ship that we buy what the herd is buying. This is the fashionable story or a theme or a fad at this point of time. Sometimes we sell what the herd is selling. Sometimes we are like a connoisseur, that we happen to come across a very good business and we hold it for a long period of time. Sometimes we are just like a raider. We just buy for a quick gain and sell. Sometimes we behave like a rabbit, that you just buy and you avoid selling a company at a loss because you want to recover the money and break even. So investor is not a uniformly rational at all point of time, because of simple reason is that most of the investment decisions are not taken on fundamentals alone. There's a lot of emotion attached to it, and sometimes we do behave like a deer with headlights flashing in our eyes. We know something is wrong, but we are frozen sometime to act. And that is the time. Actually, if you see, most of the investors start paying real focus on their portfolio at the time of stress. They are very careless when the going is good. It's only in the time of stress they put a laser sharp focus on what's went wrong or what's gone right. This is a human tendency, because when the going is good, nothing sedates human mind like dose of easy money. But the losses are highly painful. It's very demonstrated that loss of $1 is 4 times more painful than a gain of $1. So it's only when the losses start coming to the portfolio, that is the time we start paying a lot of attention to the portfolio dynamics. So this is the dummy's guide of selling. It mimics the tech meme, which says, there are experts who know, they have the insight, they have the timing, they have the frameworks, they have the temperament, they have the zero remorse in selling. And they sell what is insightful, and the stocks go down. And there are some guys who are just, as you told, go with the herd. They are momentum players. When the markets are rising, they are extremely adventurous. When the markets are falling, they are extremely cautious. They become fixed income investors at that point of time, and they behave. But large majority of the analyst community in general actually tends to get caught into all these things: valuation, terminal value, DCF, competitive advantage, float, moat, all kind of stuff. Actually, if you really look down, nothing new has been written in the investing world since 1940s. The terminology changes. I'll give you an example. What was statistically Six Sigma event became outlier in Malcolm Gladwell's book, became a black swan in Taleb's book, and so on and so forth. It became outlier, it became all kind of names. It's the same concept repeated in different language. Nomenclature changes, but the facts remain that basically ownership of good businesses held over a long period of time creates wealth. That nothing new has emerged since 1940. Since the book on the security analysis and the investment, intelligent investors came through. So to conclude the first part of the presentation, selling is a blind spot of the investor. Not much is written about it in the mainstream media, while there is tons and tons of literature on the buying side. Also, selling is very emotionally difficult decision to make, because when you are selling at loss, sometimes you are realizing you have made a mistake. And when you are selling a stock which has done very well, endowment bias creeps in, that you become the owner of the stock, you treat yourself as the owner of the stock, and selling is emotionally extremely hard decision to make. If you look on Bloomberg, prior to MFID regulations came in, only 1.7% of broker reports were on sell. And there are nuances based on that, because if brokers were to write sell report on the company, they would lose access to the company, which they require for a long period of time. So there are many underlying currents which results that selling is a very non-talked about topic in the investing world. Let's try to address some frameworks. This is most difficult decision to sell, which I will explain to you why. So let's go on the right side of the panel. So if you are selling a multi-bagger or a winner, there is a probability of seller's remorse, that you sell the stock and the price goes up. It keeps going up. And this is a company you understood, the management you trusted, you held on for a long period of time, and the regret sets in that you sold out too early. And look at the decisions when the sell is at a loss. It forces you to A, recognize your mistakes. B, it results into loss of capital, which is very painful decision. Also, sometimes you don't sell, but you wait for break even. And then you'll end up incurring the alternative cost of deploying that capital somewhere else. There's a time correction. Also, it creates a lot of self-doubt that are you capable? Are you doing your job? Do you know the topic well? So selling at loss triggers of all kind of self-doubt and issues, while selling the winners creates a seller's remorse kind of a phenomena. And even the best in the markets have erred on selling. So if you look at Stan Druckenmiller, he's probably got one of the greatest track record of performance since he's been investing. At the start of tech boom, he shorted tech stock because they were getting expensive by his yardstick. He incurred 600 million loss. But then he happened to meet some young engineers who taught him that internet and all is going to change the world. So he covered the loss, and the market kept going up. The tech got going up. And he actually entered on the day when the Nasdaq peaked. He invested close to $6 billion, and he lost half of it within 6 weeks, and he quit the George Soros firm where he was a portfolio manager. So even some of the best, Warren Buffett, if you see in peak of COVID times, he sold off his airline stocks. And all them rallied after the COVID became a lesser of an epidemic. Even Bill Gross in fixed income, he is considered, the father of fixed income investing kind of thing, Ren Pimco. He held on to a large position which was a arbitrage position where he was betting on the convergence of the spread, and he lost 44% of his AUM. So you are not alone. There are experts who also make errors of commission on sell decisions. If you look at this person, Isaac Newton, probably he was the smartest human being alive. Also, many of you may not know that he was very well connected. He was almost ranking cabinet minister, and he was officer of Mint, which is functionally equivalent to a position just below the governor. So he was very well informed individual with one of the highest IQ. So just like East India a company was set up to exploit Far East, they had a South Sea company to exploit the Mediterranean. And he entered very early, and he made something functionally equivalent to a fortune when he sold. And he was happy at that time. But what happened afterwards? He saw his friends getting richer, and he couldn't withstand that, and he borrowed the money, entered at the top, and almost became bankrupt. And that's what forced him to say that I can predict the motions and the movement of the stars and the sun, but I can't predict the human madness. And this is the problem when you sell at the profit. What you own looks like a dump yard, and what you don't own looks like Tesla Cybertruck, right? But there's a deep amount of data points here. Look at this. Buy and hold doesn't mean buy and forget. I'm now coming to sell decision. We have been told our investment period is forever. Wealth creation in long run, compounding in long run. But guys, it's good. In long run, we are all dead. Long term is a series of short term, and you have to live through that short term. So if you had invested in MSCI China, what Rajiv alluded to, you would have not made any return for 3 decades almost in real terms. Also, buy and hold doesn't mean buy at any price. BAP investing. Their valuations don't matter. In long run, a good quality business will create value. One of the only thing you can control is your entry price, and your future returns are function of current price you pay. If that is a not thought through, carefully examined decision, you will have this kind of unintended consequences that you could have 3 decades of zero returns. And 3 decades look like nothing, but if you have to live through it, it would look like eternity. It will be functionally equivalent to a lost generation of investors who would never enter the market again. Again, buy and hold doesn't mean you keep waiting for break even. So I hope these concepts are very clear that while wealth gets created in long term, and the compounding equation, N is the exponential function and longevity is everything that matters, but it's very rare animal. And I have data points to show you how rare it is in the coming slides. So look at selling from different vantage points. Selling is not a decision which suits, there's no magic formula which I can give you which will fit to everybody. Because circumstances, context, everything differs. There's no uniform formula. So it's something functionally equivalent to a blind man looking, looking and touching at an elephant and coming to a different conclusion. Let's examine some of them. Selling decision also depends upon what vantage point you are looking at. Let's look at government. Government, if it is to sell its stocks, has to worry about politics, has to worry about trade unions, has to worry about deficits, so on and so forth. Promoter, when he sells, he has to worry about, his personal needs, his diversification, and so on and so forth. A P fund or a VC fund or a mutual fund has to worry about, liquidity, has to worry about end of life of the fund or change in fund manager, redemptions, mandate of the fund, restrictions, regulations, so on and so forth. And if you are an investor who's investing through a vehicle, be it a PIF or a mutual fund or some kind of a structured product, you have to worry about the strategy, the style drift, the commissions, the taxes, redemptions, and so on and so forth. So there's a wide range of decisions and input points which go into sell decisions, and people behave differently. So sell by somebody doesn't mean a negative endorsement on your stock, and same way a purchase by somebody, however reputed, doesn't mean an endorsement on your stock either ways. One thing I've learned hard way is, there is only one reason to buy, but many reasons to sell. And I learned this the hard way. When the Page Industry IPO came through, I bought because I was aware of Fruit of Loom, I was aware of Jockey, I was aware of Calvin Klein brands, and so on and so forth. But promoter kept selling in drips. And I kept thinking to myself that this guy knows better than me, and he's selling. Why should I stay invested? And I sold out, and the stock has probably gone up some, I stopped counting. So one thing is clearly created that promoters have genuine reasons to sell at times, and sometimes sell by promoter doesn't translate. Obviously, you got to revisit your decision at that point of time, but it just doesn't automatically becomes a sell if promoter decide to sell a small fraction of their ownership. If you ask an ordinary audience, what are the reasons to sell, they will normally come out with the 4 hypotheses, which I call 4 Bs. Either the valuation is bizarre, or the business model is broken, or your initial hypothesis is busted, or there is a band in management, that management character has changed, that they have done something minority unfriendly or some capital allocation mistakes. But underlying this iceberg, there are many issues, ranging from tax leakages to macro issues to personal lead to share in market loss to loss harvesting, and let's revisit some of them briefly. So this is a slide which gives you that reasons to sell are inversion of reason to buy. If you are confident about the company's business prospectus, then the inversion of that is manifest in selling. So it's actually a mirror image of buying decision. The reasons to sell are mirror image of reasons to buy. If any of the reasons to buy no longer remain valid, then it's a sell. And when your facts change, or when your conviction changes, or when management changes, that's a time to sell. This is a framework, I think, so most of the investors will intuitively get it. But what I want to discuss was something else. Let's learn from the mistakes of others. Many people learn by committing mistakes themselves, and I am one of them. But I'm sure all of you are smarter than me, and you will learn from the mistakes of others. I'll take this slide carefully. Reasons to sell, I explained the macro shock like an inflation or a war or a currency or this thing, it could be sell. If in your process there is a gross overvaluation of stock or entire market, or you want to switch into something more better, or you have bought a cyclical business which is at peak margin and at peak valuation, or imagine you have a very poor initial sizing. It has happened in me in many cases that I couldn't buy all the quantity I know. And then it becomes a rounding of error of the portfolio. What do you do with this kind of companies? Or reverse, that a position which was meaningful position taken becomes outperformance, suddenly becomes a large percentage of your portfolio. It becomes 20, 30, 40% of the portfolio, and it becomes dominating driver of the portfolio. What do you do on those decisions? Also, instead of you owning the stock, this is when stock starts owning you. Also, you have borrowed somebody else's conviction and the stock price is down. What do? Or you have a personal deal. Or there is, you need to harvest tax to offset loss. So there are many reasons why one could sell. Let's look at some of them. A macro event. Every rise in interest rates always results into some kind of a financial accident. This is a history of last 100 years. I can go back to 600 years and show you the same. Whenever interest rates rise, obviously the valuation of the other assets has to fall because interest rate is the center of gravity which pulls down the valuation of all the asset class. Imagine if you bought the market at a wrong valuation. So look at this Japanese bubble which happened in early 1980s. Land bubble was so big that the palace of emperor was valued more than the entire state of California. And if you had bought in any of Japanese stock at that point of time or the indices, the probability was you would not have made zero return for almost next 40 years. So wrong entry point has a huge bearing on your future returns. Or imagine a bubble in Nifty stocks. In 1980s, the banks in US were allowed to sell the shares to general public. And they sold all the good names. There was nothing wrong with these businesses. These businesses are strong, moated business even today, many of them. But they were bought at wrong price. Starting PEVs were very egregious, and 10-year annualized return afterwards were negative. In fact, most of the investors lost 70 to 80% of their capital in a decade. In spite of buying the right business, they bought the right business, but at the wrong price. Or when a sector becomes very egregiously valued. So if you see, during tech bubble, technology became 33% of the index. 1/3 of the economic activity became tech, TMT. This was something you could not have sustained. Again, infotech today is becoming almost 30% of the market cap. So whenever there is a large spike in any sectoral market cap versus its profit pool, you know the forces of mean reversion will act and correct this. Nothing wrong with this stock, just similar to what Rajiv said. He chose Infosys, I chose Wipro. Wipro at one point of time was 4% of India's market GDP. One stock was 4% of India's GDP. And the company has done everything right in subsequent years, but it has taken, again, almost close to 2 decades to break even. So as an investor, you have 3 decisions to make. First is, you ignore the bubble completely. I am married to my process. I don't care about what is happening in the outside world. Let me be a stoic. Let me be a sage. Don't do anything. Or a second, okay, let me ride the wave. I got on this wave early. Let me ride it to the glory and the fortune. So they say, in every man's life, there comes a time when taken to extreme creates a fortune, something similar to that. But the worst thing is to getting trapped in the bubble, where you land up buying at the wrong time and selling at the wrong time, resulting into permanent loss of capital. This is something we have to avoid. It's fine with the first 2, it's not fine with being the last outcome. And also please remember the arithmetic is not equal on buying and the selling side. If you lose 50% of the capital, it requires 100% clawback to break even. The mathematics is very harmful on the downside compared to the upside. So especially, imagine if you run a concentrated portfolio and one of your positions which are large give you very large losses which impacts into portfolio. So concentrated portfolio, this could be also a reason to sell because large concentrated positions creates very huge amount of mental dissonance. This is one thing which has helped me, and I think so all of you should pay attention. Most of us are investors in listed markets. And in listed markets, the valuation is already given to us every day by the market. Enterprise value is known. Debt of the company is known. Market cap which you are paying is known. So you can use the DCF in a reverse way, where you can solve for the embedded growth rate given the certain assumptions. You can play around with the sensitivities, and you can realize that certain things are not possible. So at the peak of Cochin shipyard market, it was almost factoring that India would make 13 aircraft carriers, while US today has 11 aircraft. So the problem was when you are investing in Cochin Shipyard at this valuation, you are giving a very long telescopic view of valuation. And the problem with the telescopic valuation is, even if you shift your telescope by 1 degree, you start looking at a new galaxy. Forget new star, you are in a different galaxy. Same thing you can work out backwards in multiples at sector level and at aggregate levels and at indices level. So if you had just looked at this one thing, that price to sales of global defense companies 1.8 sales, they earn return on capital of 11, but they have 51% of exports. And Indian defense companies have 1% export, 11 times sales, and this kind of return on capital. Would they be sustainable? Will the government of India allow 25% return on capital going for a couple of decades? That's a question you got. And if the answer is right, good, stay invested. But without questioning this framework that what are the embedded expectation in current gold prices, it would be meaningless to stay invested perpetually at all point of time. Always invert this Carl Jacobi statement. So these are again the inversion. If you really look at it, Accor Group with 5,000 property and 8 lakh room has probably same valuation as Taj with 24,000 rooms. So already a lot of future growth is baked into current price. That's a conclusion one draws. And then the selling decision is left to individual. But you can't fight these conclusions. These are empirical evidences. This is a slide taken from ICICI Prudential Mutual Fund. They run this as a public service. This is past statistic data that whenever overvaluation companies, either through the forces of market or through the forces of creative destructions, mean reversion. Please remember, profit margins are mean reverting. Valuations are mean reverting. They always mean revert. There's nothing known as, this new thing is a very dirty word. This time is different. These are 4 dangerous words in the market. As far as valuation is concerned and as far as the profit margins of the aggregate economy, they always mean revert. That's been the case so far. Also, one of the toughest decisions to sell is switching. When you are selling to buy something where probably the risk is lower or reward is much higher. Look at this decision of Warren Buffett when he sold Apple and when he sold IBM and he bought the Apple. This was the right decision to do, but it required you to force you to have a view on IBM as well as view on Apple's prospect going further. Doubly compounded and a doubly hard decisions to make. I've been particularly guilty of many of these decisions. Another thing is importance of stop loss. Whenever we are buying securities, we are in a way telling the market that we know more than the market, right? We are trying to be a little more aggressive, that we know better than the market. But at times, collective wisdom of market is also better than yours because you are not prone not to make mistakes. And that's why every time there is a meaningful correction in the stock prices, one has to take a feedback that market is disagreeing with you and revisit the assumptions. It's a time to revisit the assumption. I'm not saying that you sell out. The issue is, but please do revisit that all your hypotheses which you entered into the stocks remain valid at that point of time. And if you don't have a stop loss, some funny things have happened in the past. All of you are aware of the statistical significance of investor failing to consider price loss, time loss, and tax loss. All these 3 losses one has to be mindful of. And this is another thing where, Bill Ackman was considered baby Warren Buffett, Nick Slip, we heard all of them. They bought concentrated positions and they lost a lot of money. And concentration is a double-edged sword. It amplifies the gain, but it amplifies the pain also. So when this happens, psychologically it becomes very difficult, and I've seen many investors losing their bearing when this kind of situation happens. So concentration coupled with large losses is an extremely volatile position where maximum mistakes are made in the investing career. Also, many reasons to sell would be to set off the capital gains tax, to avoid paying the tax. It's a very sound strategy. Many of us don't do it. Some of us do it very clearly. But a penny saved is a penny earned, and whatever you sold, you could theoretically buy it later on, right? It's no harm in booking temporary loss and buying it back. Again, easier said than done. Once you sell the stock, it's quite difficult to buy it back. Coming to the last portion of my presentation, I wanted to not just give you theoretical framework, I just wanted to share my own personal experiences. And my biggest mistake has been this. I have sold stocks too early. The acts of selling stocks early far outweighs any of the bad investments I've done till date. Let's see some of them. So when you sell, this kind of a flowchart is what is my decision-making framework. You can take a picture of this slide. This is my framework, works for me, may not work for you. So whenever there is a stock mark-to-market loss of 25%, there is, if you have not added to the position, I'd send to sound out my position to some good colleague, like I would reach out to probably Rajiv or Durgeva or somebody, and take an independent valuation. This works for me. But if I've added, then it's fine. Also, a stock has become multi-bagger, super compounded gain. Then one has to keep asking, will the PE multiple will expand or the earning per expand? And again, if the markets are at all time, then again you see whether they... So this is a flowchart which I kind of run. It's a probabilistic scenario planning. There's no sanctity to any of this decision because what could be positive for me could be negative for you and vice versa. But this kind of simulation is what keeps me agile and aware of the kind of risk I'm taking or kind of opportunities I'm foregoing. Also, single biggest mistake that many of the investors make is they buy businesses which are cyclical at peak margin and have large balance sheet leverage at overpaying price. This is a killer combination. It results into, if not losses, it at least even results into, a Kumbh Mela kind of a situation. You will get an opportunity to exit the stock after 12 years or 14 years, vanvas, if that's what suits you. But basically, it's a very painful process if you make this kind of a mistake. Personally, look at the reasons of mistakes, stupidities I've made, and here I have a fortune to stand here and speak to you, but these are my own mistakes. So just shows how bad an investor I am. I've sold, avoid paying short-term capital gain, I held on to ACC and lost almost a lot of upside. This is a company which I owned meaningfully. It became very expensive, float was low, sold off, stock ran up. I used to own 1% of this company, by the way, at one point of time. The promoter, the CEO left. The promoter was not aware of this business. I sold the shares and stock. It's as if nothing has happened. Nothing has happened. But in interim, CEO of this company left the company, took PE investing and floated a competing company. And he was considered a rock star at that point of time. Again, Page Industries is an example I've told you. Position error. I couldn't buy meaningful stock, and it became a small position, and we sold off, and the stock has run up. Regulatory risk. This is a company where suddenly overnight government announced a price control on the selling price of seed. They froze it to 850 rupees a seed, no matter which category of seed, what quality of seed, whose seed, nothing. And we sold off. Right sell decision. Early when I was in the college, I had bought Hero Honda shares. I sold them to buy my house, and that has been the biggest, costliest mistake house purchase I've made ever in my life. If I had not sold those shares, I would have been in a different orbit. And there are certain stocks which I know they are cyclical, and I've traded in and out 3 times. So selling is inbuilt at the time of purchase because of the cyclicality of the underlying business. And sometimes you get the decision wrong. I've sold good horses to buy stupid donkeys. Well, sometimes I've sold good horses to buy pedigreed studs. So it's a probabilistic error. You can't aspire to get all your decisions right. That's the key takeaway I want to get, but you've got to be mindful of the framework when you are selling. Now, max mea culpa. This is Latin word. It says my maximum mistake. This is the mistake which pains me the most. These are all the companies which I held for a decent amount of time, but I sold because they became expensive by my yardstick at some point of time. All these stocks. And one thing, I was a stupid guy. It took me 20 years to realize this. And I'm going to tell you free. I used to value the stock based on my perception of what was cheap or what was expensive. So my cost of capital was very high. Little did I realize that there could be some guys like government of Singapore who are happy with 4% dollar returns annually. So expected return of lot of investors are different. And as the companies scale, as they become liquid, as they become scaled businesses, it attracts investors with lower expected return than yours. It's the incremental buyer which sets the price. Once I had bought the price and I was not doing, I had no opinion on the, I had no impact on the share price. It is the last marginal buyer and the last marginal seller which determine the price of the share. And I completely ignored the fact that larger investment with lower threshold of return expected would enter the market and drive the price. I was arrogant that I was the settler of the price. I was the arbitrator of the cheapness or expensiveness of the stock, and that was the stupidest mistake I've been making in 20 years. And the compounding of stupidity is very cruel. And this is visible on the chart to you. Had I held on to these stocks, probably I would be sipping something in Bahamas right now, not here giving lecture to you. So this is a learning that as companies evolve, it attracts companies. This is the important slide. The expected returns by marginal investors keep dropping. And only in decline then things changes. This is the most important takeaway of my selling mistakes till date. That I used to view the stocks with my yardsticks of statistical cheapness and expensive, not the incremental buyer. Again, markets have a way of making you regret your decisions. But regrets are inevitable, suffering is optional. I urge you not to suffer. Let's look at this. I'm just coming to my last portion of the slides. Look at the three musketeers, okay? These are the founders of the same company who knew everything about the company, but based on the entry and exit time, their fortunes were very different. Same thing here, Microsoft. Bill Gates entered early, but kept selling. This guy entered very late, but never exited, and this guy who entered and exited very softly, and the outcomes of all the three. They knew the stock as much as anybody in the market. Same thing happened to Berkshire in Warren Buffett. They had a third partner called Rick Gurian. But Rick Gurian was heavily levered in 1970s. And in fact, he had to sold Berkshire share to Warren Buffett at price of $40. What I'm trying to tell you is, markets have a way of finding your weakest link and exploit that against you. Be careful. Be careful of selling as much as you are careful of buying and holding decision. With this, I have summarized. You can take a picture of this. This is what my learning over last 30 years of investing in the stock market is. One thing I also urge you is go to this Flame website, Library of Mistake. It has chronicled business mistakes and investors' mistakes. It would be a good source of learning for young investors in this room. Some of the books. I'll be putting up this presentation online. You can download it and look at it. And just thanks to the team at Flame, which has helped me deliver this presentation. Thank you.
Now, my first question to you is, out of the three decisions which an investor makes, buying, holding, and selling, which is the most difficult?
Depends
for
on
you?
time. Today, I think so buying would be the most difficult decision.
Okay.
As the market, see, as an investor, we have to respond to opportunity sets which come externally. I can't dictate, oh, I want quality, or I want value, I can't, market decides what opportunity sets are. So there are times where buying is an extremely difficult decision and selling is easier decision, which is today probably, for various reasons we can debate about. Holding is also an equally decision because there is a temptation to cash out the chips and redeploy the company, which comes with a reinvestment risk. So depending on the phase of the market cycle and your past performance, each buying, holding, or selling, all three can be very extremely difficult decision. And that's why they say investing is easy, but it's simple, but it's not easy.
Very good answer. So, what about in these kind of markets? Forget the last 1 week, but let's say we are 1 week back, and a lot of investors, including me, and are experiencing what I call as FOSO, which is the fear of selling out, because whatever you sell keeps on going up. Now, how do you overcome it? And I mean, especially with you not having you're having difficulty in buying something because of the value framework you have, or most of us have. So how do you address that?
So investing boils down to handling contradictions. Investing is bundle of contradictions, right? I'll give you a simple example. On one hand, you have to be confident that you know more than what market does. And on the other hand, you have to have humility that you could be wrong and market is collectively. On one hand, you have to be, of a mindset that I know everything. Or one thing that I don't know nothing and market knows everything. So investing is a bundle of contradictions to begin with. And especially when it comes to selling a winner, which is what you are describing, fear of selling early. The key is what I told, that at the current price, what are the future embedded growth rates embedded into the business? So a business can make money only in 5 ways, actually, 7 ways, actually. One is pay lower taxes. I don't think so companies have control over that. Pay lower interest costs, by and large, no control, that dictated by market. Increase margin, increase turnover of the using the same asset turnovers, or fund the assets cheaply. The two other ways to make money is if you can repurpose assets to a better use, like demerger or successful spin-offs or something, or if you can raise money cheaply at favorable terms. And when I'm saying money, it is both debt and equity. So with this arsenal, you can play around with sensitivity analysis of past, the peer set, comparable peer about, and take a view whether you are paid to take that risk from this valuation ahead. And being market would overshoot the valuation and you would land up taking an early exit. But when in the selling the winners, I like what Rajiv said, you start drip selling. Earlier, I would just sell en masse, I would dump the stock in 2 days and I would be out. But now, when I'm just selling for the overvaluation reason, I've started taking meaningful small drip exit. Some you will end up exiting early, some you would end up exiting late, but over a period of time, you would neutralize the average selling price. So this is a strategy which I call a foot in the door. The same happens in the buying side. You put a door so that your bias of the valuation gets eroded, and then you start averaging up or you start averaging down.
Okay. So the next question is, what do you do when the stock goes far beyond your original thesis? And I'll give you an example, a personal example of mine, if I'm permitted. I invested in a PSU stock, NBFC. The thing is, it was very cheap, just a couple of years back. 0.6 price to book. I mean, obviously, zero NPA, and I think a lot of people know about the stock. Now, this stock, the thesis was, that I'll sell it at maybe 1.2 price to book. Dividend yield was 7%, so it was kind of a no-brainer, right? And obviously the book was increasing. Now what happened is, down the line, this stock did go to 1.2, 1.5 price to book, and actually the numbers started declining, or there was no growth. And so the thing is that, I did start selling, obviously. I sold all the way to, let's say, 2.53 price to book. And the stock goes to 6 price to book. Now, what do you do in such kind of instances? That how do you process this information, or maybe learn from it, and how you can do it better, you can sell better in the future? What is your thought behind this?
So valuation of public sector banking, lending companies has been always an enigma. And one thing, Jiten, I've learned is, why they don't get a high P multiple is because of, or price to book or whatever the valuation framework you're using, is because of 3 reasons. First of all, decisions are not taken in the best interest of the investor because the decision maker has other incentives or is answerable to somebody, or that somebody is responsible for his appointment in first place, and so on and so forth. Upar se call, that's the first thing. Secondly, public sector enterprises are forced to dilute at the worst of the time. They tend to get recapitalized when the earnings are out of whack, the multiples are out of whack, unlike a private sector borrower, lender who always raises money in good times and creates a buffer for the bad time. So that's the second reason. And the third reason is, obviously, the public sector enterprise are losing market share because there's no incentive to fight for the profitability given their mandate. So all these three reasons would ensure that in long run, they ought to trade at a discount to the private sector. Now, always there will be a time where somebody takes a fancy and market would temporarily overshoot, but you can't bank on it. So the decision can't be considered wrong because something else happened. Based on the empirical data and based on the logic, the decision to sell was the right decision.
Perfect. That's what I also tell myself. uh, so, learning from historical mistakes in selling, like selling soon or holding too long, if you can give some empirical, I think you have already
So the
given quite a
slides I
few of them.
showed, there were tons of mistake of premature selling,
Right.
where I just sold because of the statistical reasons. The worst part was, I didn't take the cost of capital of the market. I took my expected return as the arbitrator of the, whether it was cheap or not, and I was a fly on the wall, didn't matter. So when you sell just for statistical overvaluation, one rule which really helps is, you got to see the behavior of the market participants. If the thematic funds are getting launched, if CNBC anchors are talking about it, that euphoria is perceptible. And you should take advantage of the euphoria because the fortunes are made because of the euphoria. If market was rational, there wouldn't be a phenomenal money-making opportunity. So instead of you getting swayed, you should take advantage of it, is what the real art of investing lies about.
Would you sell at a loss any company? And it could be obviously because of company not performing. But how much time would you generally give to the management to perform? I mean, how much time would you give an investment for you to decide, whether that okay, I need to get out of this, be it at a loss or break even or whatever.
So stupid as it sounds, if a stock falls by 20-25% and I don't muster courage to buy it more, it is the first indicator that I don't know my investing company that well, or do I have a conviction, or my homework is inadequate. Number one, it's a first warning signal.
Okay.
Secondly, you are an active investor, so you are always looking for new opportunities to invest. So at that point of time, such companies become a swift decision where you tend to recycle your capital, because a person like me don't have infinite capital. I don't have inflows and inflows like Rajiv does. So capital is scarce. So recycling of the capital is the opportunity to take at this point of time, coupled with tax loss harvesting.
So, so what you're saying is that your decision would be based on a percentage fall or
Those are statistical point of triggering an introspection. So the first question is, it was good at this price, now it is 25% cheaper. Are you buying more?
right.
Are you buying more? Are you allocating more? If that answer is clear, then it's a decision taken. But if that answer is not clear, then there's something wrong. It's a first early warning indicator, as far as I'm concerned.
Okay. Now, assuming that, let's say it doesn't fall, I want to stretch a bit more and try to get more out of you on this. Assuming that it doesn't fall, let's say it remains static, how much time would you still give the management for it to perform?
3 to 4 years.
3 to 4.
The reason is, normally cycles tend to correct in 3 to 4 years' time, on an average. Now, I can't generalize. If the excesses were very high in the past, like your GFC crisis or a tech bubble, then time would be longer. But obviously, since excesses have happened, you would be aware of that. So, but in a normal condition, I think so 3 years is a decent time for a management to apply its changes and correct. I think after 3 years, it would be again a time of introspection and deep revisit of the idea.
So next is, what if a management does a capital misallocation? Would you sell just for that? I mean, would you assess, what is the...
So I expect my partner in that business to deploy money when the future returns are lucrative. And I would want them to stay on the sidelines when they are not. And that's also, again, a function of market opportunities, stress in the sector, and so on and so forth. Minor capital misallocations, I tend to overlook. But anything which substantially moves the needle by 20, 30, 40% of the capital deployed, that would be a reason again to sell. Unrelated diversification, overpriced acquisition, so on and so forth.
So let's look at something like, for example, ITC, just as an example. Uh, Obviously, we know the business it was in. When it spawned the FMCG business or something, I mean, what would you look at it? I mean, would it be a diversification in your mind, or it would be, getting future ready because cigarette is a dying business? Which is the lens you would look at it? I mean, assuming you were a shareholder at that point in time or something, what is the way you will look at it?
So firstly, Jitin, ITC is a company I wouldn't own because one of the filters I have is the company which I own, which I consider to be an owner myself, has to be good for society. And
Okay.
there are enough literature that tobacco consumption is not good in aggregate for society. So I would tend to not be the owner of the share. But if I had to, the reason is very clear. ITC can't return the capital because of the political issues and so on and so forth. Uh, uh, and my decision to buy ITC or sell, if I had to, would purely depend on how cheap it is and 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 if they were to get serious about spinning off the businesses and be mindful of the capital allocation, then I would hold on to it.
Okay. Now, you have done a lot of work in AI, and you uh, obviously have a company in that. Now, can you just throw some light, how AI can help uh, investors? Can it be like an assistant for you? Or, I mean, how far we are into, getting something out of AI right now which can help us in making better investment decisions? If you can throw some more light, maybe a
So,
detailed answer on this
so,
will be,
so, so
since
there,
you are there in this field.
there are three aspects about AI which investor should be aware of. And all these three are beneficial to the investor actually. None of them are harmful. First, AI automates a lot of grunt work. Grunt work of pulling in information from thousands of platforms, doing it day in, day out, processing large amount of data. This is a grunt work. It is not a decision-making part of the work. It is just synthesizing the information, getting the information, updating the information, or looking for certain predefined checklists. So all those things can be quite automated, which is increasing the productivity of the investor. So what has happened is, as the noise, see, fundamentally, Jitan, what has happened is the cost of creating data is becoming zero, the cost of transmitting data is becoming zero, the cost of storing data is becoming zero, so there is huge amount of noise. Any Tom, Dick and Harry can today put some pointers in ChatGPT and write a blog and post it online or tweet it online. So how much do you, so A, automating it, B, filtering noise, and C, consistently applying your frameworks and process on large data scale. Today you can upload, complex Excels and, ask simple queries. So AI is an assistive tool which can make investor improve the breadth, reduce the noise, and automate its task flow. It's a very beneficial tool, and I think so. Just like any other tool, just like transport or steam engine, this is a tool which is going to improve the productivity of average investors by leaps and bounds.
So, dwelling a bit more on that, let's see. I mean, it is, you give it an input, you ask the right questions, it will give you output. Let's assuming that, you are putting, you and me are, putting the same input in this and asking a similar question. The output will be similar, right? Now, the inference from that, let's say you give it the annual report, you give it the con call, you give it the uh, uh, analyst report or something, and then you ask for output. Now, the output will be same for you and me. Whereas, if I were to look at these place things in isolation, my inferences would be different and your inferences would be different. Now here we are getting a situation where the inferences which the AI is generating is same.
So, so,
Now, what will be the differentiator now in investors? That is my question.
so Chitin, the processing tool is going to be an infrastructure layer which will be available to everybody. Perplexity is available to everybody, ChatGPT is available to everybody, Copilot is available to everybody. It's like a car. A Formula One car in my hand is useless, but Formula One car in the hand of racing expert is highly valuable. So how do you use the tool matters. Three things: asking the right question, getting the right data inputs, and data inputs are very important. 70 to 80% of the mistake happens because of the faulty data, or incorrect data, or inconsistent data. In fact, machine learning and AI is all 80% of the thing is non-glamorous work called data cleaning, and getting it in sorted format. So right data coupled with right question, which is the right prompting, coupled with right inferences will be a distinguishing factor in my opinion.
Okay. So I'll take some audience questions. There's a question from Jitendra. Whether the decision to sell was the right or wrong, we know only in hindsight. But you have to look at your own experience. Which reason to sell a stock has led to least amount of regrets? And which reason has led to most amount of regrets?
So decisions to sell with low regrets are where you could, if you were to ask the question again, the justification still remains the same. So when we sold because of regulatory issue, or when we sold because of overvaluation or whatever, as long as the underlying reason. So the best thing an investor could do is create what is something known as, Jitendra, a pre-mortem journal. You assume your decision has gone wrong, and you try to see what could be the reason of it, and how would you feel at that point of time. So now what I do is, when I decide to sell, I mentally ask this question: oh, this stock after a year is going to be a smack on your face, 30-40% higher. What would you wrong, and how would you feel about it? And as long as still answers keeps coming the same, I think so then you shouldn't torture yourself to death, because that's your limitation, that's your DNA, that's your karma. And investing is not about maximizing everything. It is about sleeping well at night. And you can sleep well at night if you know that your decision has considered pros and cons, and still you have come to the same outcome.
Would you consider yourself as a lazy seller, like Pulak puts in his book, that we are very lazy sellers?
I'm exactly opposite of Pulak. I'm a hyperactive investor. He's got the capital which is on call.
Okay.
He can demand capital from the investor when he wants to. He demanded it in GFC, he got it. He demanded it in COVID, he got it. Unfortunately, I don't have that luxury. So again, going back to the same thing, I can't copy-paste his playbook. What works for him doesn't work for me. He has capital available on a phone call. I don't have. Copying his idea would ensure that I get ruined.
Perfect. So there is a question from Gaurav. Do you have a framework on selling of a multi-asset class portfolio or a multi-geography portfolio as well?
Unfortunately, I'm married to equity as an asset class, but I do look at fixed income when the equity not becomes investment, but it's a plain vanilla equity investing, fixed income investing. So unfortunately, no, I don't have the experience of multi-asset and multi-geography, because bulk of our capital, because of capital control, unlike Rajiv, who can export capital and buy, a person like me can't in meaningful way. So it's a binary portfolio. Equity default when the valuations and the understanding permit you to, and when you find everything expensive, some amount of fixed income. And yeah, that's what it is for my investing career.
So there's another question. You mentioned which company you sold and what mistakes you made. Can you name some stock you help and have had great returns, and why did you hold it for long?
It would be stupidity to, I won't go into names.
Right.
Some of you know, some of
Yes.
you people know the stocks I've been owning for decades. The reason to hold a stock for a long period of time would be four, in my opinion. A, addressable market is very large, and the competitive intensity is not too high. If addressable market size is high, but the competitive intensity is high, then it's off. And I'll give you an example of telecom. When I got first mobile phone, there were 26 mobile operators and everybody was profitable. And today, telecom has been a vertical growth story of India. But There are 2.5 players, of which only one is making profit. The remaining two are either an accounting loss or an actual loss. So there has been a growth in the underlying addressable market, but nobody's made money. So please remember that all form of growth are not value accretive for investor. Cancer is also growth, but it's unwanted growth. Please remember this. Cancer is growth. So don't blindly chase growth. Growth is value accretive to investor only if it beats the expected return on capital and there's no dilution. So that's one framework. Second framework would be, the management. You can trust the management skills and you can take them to navigate the changing water. The changes are very rapid, technological obsolescence, business models, so on. So your comfort with the management to navigate the troubled waters is second. Third, you keep saying that your third or fourth or 10th better alternative is still worse than the current opportunity. And fourth is, just simply that your comfort with the stock is there where you are okay to have some lower return, but you want to prolong the longevity of the growth. So this is the framework with which one can hold. I've been fortunate to hold certain companies for a couple of decades also, and they've delivered good returns, but I've been more guilty of selling good stocks very early rather than... So number of stocks which I've held are far lower than the number of stocks I've sold too prematurely. So that sums up how much of a bozo I am.
No, you are excellent investor. We all know that. You're being modest. So I think last question I will ask. What about all the investors who have come into the market post-COVID? They've only seen a vertical rise and, seen their portfolios blooming. Now with some hint of a correction setting in, what is your advice for them? Because you see lot of people asking questions already. A lot of people are panicking just with 1 week of correction. All of us who have been in the market for long times, we know that this is nothing. I mean, this is par for the course, or obviously I can't time it, but it can go far longer. What is your advice to all these investors?
I have a very simple advice. Whatever you are going to go through, your predecessors in the past have gone through it. History is littered. History of stock market is history of human behavior with money and the business in the past. And nothing new has come. So learn from the mistakes. So read about history. I have specifically 3 books I can recommend to you. Read a book. It's not a popular book. It's called Bull by Maggie Malhar. Secondly is also another not popular book, but what I consider one of the best book in risk management is called Devil Takes the Hindermost by Edward... no. Huh? Devil Takes the Hindermost, I think so. It's a very good book. And read about, Howard Marks things on cycles. Absolutely. And you got to read about history because whatever we have gone through, our human race has gone through it. And the best way is to, learn from the mistakes of others rather than committing mistakes. And if you have not seen a bear market, unfortunately, thing is, you can't become a romantic just by reading Mills and Boon's novels. You got to experience the love to become a romantic. So either you will go through the experience or you learn from the mistakes of others and avoid it. And I wish second would be less costlier than the first one.
Great. I think time is up. We can stop. I don't think there are any further questions. So thank you so much.
Thank you.
And